If you're a new bookkeeper or you're just starting to manage books for a business, this video might just save you from a massive headache later on. One of the most common mistakes I see new bookkeepers make isn't complicated, and it's not because they're careless or bad at math, it's miscategorizing transactions. And the scary part? You often don't realize anything is wrong until tax time, when your books don't reconcile, numbers don't line up, and suddenly everything feels broken. Now, quick reassurance right up front. This is not the end of the world. Mistakes happen. Every bookkeeper, including experienced ones, has dealt with this. But doing what we can to be more accurate going forward makes everything easier. Cleaner books, smoother tax filing, and way less stress if the IRS ever asks questions. So in this video, I'll walk you through why miscategorizing breaks everything downstream, how this affects taxes and audits, and the two core concepts that unlocked bookkeeping clarity for me and stop these mistakes almost. Let's start with why this happens so often. New bookkeepers are usually taught, just pick the closest category, you can fix it later, it doesn't matter that much, and in the short term, it looks fine. But when transactions are miscategorized, accounts don't reconcile, you see duplicate income or expenses, balance sheets don't make sense, and tax reports start throwing red flags. The bookkeeping software isn't broken. It's doing exactly what you told it to do. The issue is the logic behind the categorization. Here's where things get serious. If something isn't categorized correctly, and especially if there's no receipt to support it, it may not qualify as a business expense in the eyes of the IRS. And that can mean adjustments to your tax return, paying additional taxes you didn't expect, possible penalties and interest. And if there's ever an audit, the IRS doesn't care that the transaction felt like an expense. They care about proper categorization, clear documentation, and receipts that support the claim. This is why clean books aren't about perfection, they're about defensibility. Now, quick reassurance, and let me say this clearly. This is not the end of the world. If you've already made mistakes, you're not alone. You didn't ruin anything permanently, and most issues can be corrected. The goal is not perfect books forever. The goal is better habits, clear logic, and accuracy going forward. And that alone dramatically reduces stress, cleanup work, and tax issues. So here's the first big unlock for me. And this single idea changes everything. Every account, no matter how specific, fits into one of these three buckets. Everything is either an asset, a liability, or an equity. So assets, these are the things the business owns. Cash, bank accounts, equipment, accounts receivable. Liabilities, these are the things the business owes. Credit cards, loans, taxes payable, accounts payable, and equity or the owner's stake. This includes things like owner's contributions, retained earnings, owner's draws. Even if something has a subcategory, it still belongs to one of these three. When new bookkeepers struggle, it's often because they jump straight into the subcategory without thinking about the main bucket first. Before categorizing anything, ask, is this an asset, a liability, or an equity? If you can't answer that, stop and clarify, because everything downstream depends on it. Once you anchor transactions to the correct bucket, your balance sheet starts making sense, transfers stop being recorded as income or expenses, duplicate entries drop dramatically, and reconciliation becomes easier. Most bookkeeping errors aren't random. They're classification errors at the top level. The second big unlock, money only moves in 5 ways. This is the framework that simplifies everything. Every transaction falls into one of these 5 movements. Money in, like income and payments received. Money out, like expenses and payments made. Transfers, like checking to savings or from one bank account to another. money I owe, like credit cards, loans, taxes payable, and money owed to me, like accounts receivable, client invoices, and that's it. When you miscategorize, it's usually because a transfer was treated like income, a payment toward a liability was treated like an expense, or receivables were ignored entirely. Before categorizing, ask, which of the 5 ways did money move here? Answer that first, then pick the category. And here's how this prevents tax problems. When you combine assets, liabilities, equity with the 5 money movements, you get books that reconcile cleanly, produce accurate tax reports, are easier to explain to a CPA, and are much safer in an audit. And remember, if something isn't categorized correctly and doesn't have a receipt, it may not qualify as a business expense. That's why keeping receipts matter, asking questions early matter, and checking in when you're unsure saves time later. To keep everything smooth and stress-free, especially if there's an audit, it's always best to keep receipts, add clear notes to transactions, and check if you're unsure. And if you're working with me or watching this channel, I'm here to help with that anytime. It's always easier to fix a question now than try and untangle a mess months later. So quick recap. Misclassification is the #1 mistake new bookkeepers make. It's not the end of the world, but accuracy going forward matters. Incorrect categories plus no receipts can cause tax issues. Everything is either an asset, liability, or an equity, and money only moves in 5 ways. If you master those 2 ideas, bookkeeping becomes cleaner, faster, and far less stressful. And if this helped you, stick around. I'll be breaking down more beginner mistakes and how to avoid them before they turn into tax time nightmares.